Hi, my business's name was Flanagan's Gym. My first business strategy was to scale the business as quickly as possible while still being able to pay cash for everything. And I also wanted to maintain 100% ownership of my gym by not selling any stock off. My second business strategy was to raise membership prices as the number of amenities in the gym increased and also the quality of the amenities. My third business strategy was to use retail items to further increase the profit of my gym. And last but not least, I wanted to hire employees with varying strengths to further the gym's offerings. For Flanagan's Gym's horizontal analysis with Hoppy's Gym. Hoppy's Gym had a higher net revenue, cost of goods sold, gross profit, and operating expenses. But when it came to net income, Flanagan's Gym beat out Hoppy's Gym by about $8,000 or 10% in the total net income. For the vertical analysis of Flanagan's Gym, the gross profit was 72.8%, our operating expenses are about 33.3%, and our net income is 39.5%, which is the highest net income percentage of the four gyms we are discussing. For Flanagan's Gym's ratio analysis, I made a mistake in the game, and on day 60 I paid all my liabilities off, so my ratios are sort of skewed. My current ratio is $123,313.88 to 0, and my debt to asset ratio is 0 to $123,313.88. While it may seem nice to have no liabilities, if I were to go to a banker or investor and say I have no liabilities, they're probably not going to like how that looks on paper. And also, it's not an accurate representation because for most of the game I did have liabilities. There were days I paid everything off and there were 0 liabilities, but overall I had liabilities. So the 0 isn't a totally accurate representation, even though it is the representation of my game on day 60. For Flanagan's Gym's overall evaluation, after 60 days, Flanagan's Gym was profitable, ending with a net income of $79,314 or 39.5%. Even though the gym was profitable, there were a few things I would change if I could play the game again. If I had scaled quicker, if I had taken out a loan, I could have charged higher membership rates sooner, increasing my profits. I also could have further upgraded my equipment in both quality and capacity, which have also allowed for a higher membership fee to be charged. For inventory, I ordered every 3 to 4 days, and I ran out a couple times of food and water. If I had changed my inventory ordering frequency to every 2 days, I would have eliminated those missed sales of food and water. I also had some employee turnover. I had 2 employees quit, and if I played again, I would try to adjust some of this with the employee satisfaction.
All right. Hi, everyone. My name's Jeff Hopkins, and my gym strategy is as follows. The name of the gym, Hoppy's Gym. The net revenue, $313,291. Gross profit, $231,722. Net income, $71,267. Ended up with 2,000 members and 16 employees were hired. For the overall business strategies, I definitely eased into the business with a non-aggressive approach. I had myself in some trouble in the practice attempts where I had a lack of funds come day 8 when most bills were due, when I went too aggressive. So I started milder. Started with the basic equipment and the site that allowed for the weight equipment to be added. I did, however, focus on advertising to get the word out to new customers and attract more business and hiring experienced employees to provide good customer service out the gate. Employees, I definitely hired more than what seemed typical. Hired 5 employees on day 1, 4 employees on day 2. This was to focus early on having satisfied customers with the hopes of attracting more. As clientele increased, 3 more employees were hired day 17, 2 more day 38, 2 more on day 58. Membership fees started with $16 per week and ended with $26 per week with 2,000 members of the gym. And the goods sold, the beverages definitely seemed to sell at a much faster rate, so there was more emphasis on getting the products available. I started with purchases from Gym World at a fast rate, which was the lower quality product. As members increased, along with cash, ended up switching to the premium product at a fast rate. Horizontal vertical analysis. Hoppy's Gym focused significantly on number of employees and employee training, emphasizing the customer service, keep the members happy. This contributed to a high number of operating expenses, keep revenue up by try to keep stock of beverages as much as possible, as they were the quickest product to sell. The gym sold 5,338 beverages, 2,343 in foods, 1268 in clothing. Although my gross profit was 58.4% higher than Flanagan's Gym, my net income loss was minus 10.1 due to the gym's high operating expenses. Vertically, I had higher operating expenses, lower cost of goods sold, and lower net income compared to Flanagan's Gym. The operating expenses could have been kept significantly lower if not for expenses related to the number of employees and employee training, benefits, and all the marketing programs that were implemented to target additional members. Lower operating expenses would have increased the gym's net income by the end of the 60-day period. Ratio analysis. I had significantly higher liability percentage of 15.4% compared to Flanagan's Gym. The two major contributors for this related to my gym are the trainings, benefits, and salaries for the 16 employees, and the marketing strategies to target more members. Current ratio for every dollar of current liabilities, I had $6.47 of current asset. Debt to asset ratio, I will have to liquidate 15% of my business to pay off all debt compared to 0% of Flanagan's Gym. And the overall evaluation, gym was rapidly growing, was able to eventually maintain a high number of members, 2,000, with a high customer satisfaction rating in the mid-80s. This was even though the equipment was kept at a mostly basic level at the premium site. However, by keeping the equipment at the basic level would cost more to maintain them and contribute to high operating expenses. Those expenses also came from hiring a high number of employees relatively early on, providing training to the employees that lacked experience in a certain category. Keep employees happy, I increased their benefits as gym generated more business. Without the premium site and variety of equipment early on, the gym only gained just a few members and did not increase significantly until the workout options broadened for the clientele. 47% of my assets were cash, while 53% of my assets were inventory, transportation, property, equipment, startup. No additional loans were taken out. Considering this type of business with the allotted startup money, I would consider attracting more members quicker by getting more equipment in the gym as quickly as possible. It was only then that I saw the number of members grow significantly. At this point, I would have fewer operating expenses as it relates to employee training, assuming the current employees held their positions with the business. I would continue to improve the gym equipment and provide raises to employees to keep morale up. This would cause me to have increased the expenses and would work toward a higher net income. Thank you. That's Hoppy's Gym.
Hi, my name is Nicholas Disher, and I made Nick's Gym with a net revenue of $392,000 with a gross profit of $304,000 and a net income of $144,000. At the end, it had a total membership of 1,388 with 9 total employees. For the initial strategy, the goal was to buy every type of equipment in the largest possible capacity building. This allowed for a quick rise in membership. which allowed for immediate cash flow. The poor quality goods were bought first, and then eventually were upgraded to meet customer service demand. Initially, poor quality equipment was bought that allowed for high capacity members on each equipment. This allowed for a lot of membership. Employees were hired on demand, so when they were needed, they were added. After each day, reviewing customer feedback was important to adjust the business scope. This was important to increase customer satisfaction. Pricing was adjusted regularly to meet the satisfaction of the members, sometimes going up and down, but it ended at $26, and advertisements were used based on the psychographics that matched with the gym. Comparing Nick's gym to Flanagan's gym horizontally, most notably, you'll see the net. Looking at the ratio analysis, the accounting equation resulted in $198,000 for assets, the current ratio being 19.05 and the debt to asset ratio 0.05. Having a little bit more time would have helped clear the liabilities, turning them to zero and making these ratios look a little better. The financial performance of this organization was great. Low liabilities and high revenue made this business extremely profitable. The gym made enough money to keep its staff and potentially hiring more, as well as upgrade equipment and product. This would help increase revenue in the future. There were some potential improvements that were limited by the time. So adding more staff would help the employee morale, as well as an increase in advertisement would increase the number of members. The automatic shipping would have been nice to have. That was pretty annoying to deal with. The overall financial position was great, with assets totaling up to $198,000. And after 60 days, the net profit was pretty high with $144,000. The gym proved to be very sustainable, profitable, and had continuous improvement.
My overall strategy was to start small and focus on quality equipment to keep customer satisfaction, loyalty, and brand image high and operating expenses low. I purchased high quality business equipment initially, which had a slightly higher cost but a lower weekly operating cost. I also elected to purchase gym equipment initially and waited to hire employees to keep those operating expenses low. I leveraged higher quality new gym equipment to meet a higher weekly membership rate, but purchased a mix of low and high quality products to keep my cost of goods sold lower. This was also in line with the customer profile for the business type and location, so I was pretty confident I would meet the demands of the customer. Compared to Flanagan's Gym, net revenue was 27% lower, and this was largely driven by a lower weekly membership rate, an average of about $9 for a pretty extended period of time, and fewer members initially. On day 10, I attempted to raise the weekly membership rate to $11 to stimulate revenue, but caused an immediate loss of about 150 members. It took about 14 days to recover the members' loss, which ultimately led to reduced revenue. Squat Goals had 29% less gross profit, partially due to slightly more revenue going to cost of goods sold. Even though my cost of goods sold was 22% less than Flanagan's Gym, it accounted for 29% of net revenue compared to Flanagan's 27%. And this is just attributed to fewer members. Sales revenue was just too low to realize the full benefit of the lower cost of goods sold. Squad Goals saw 49% less in net income due to lower gross profit and higher equipment costs, spending just over $117,000 on equipment. As a benefit to net income, Squad Goals had slightly lower operating expenses, just 4% lower. This is due to the overall strategy of keeping operating expense low by hiring fewer employees and purchasing higher quality equipment. When comparing vertically, Squat Goals had significantly lower net revenue, but an accurate reflection may be in the differences of their size. Both gyms had cost of goods sold between 27 and 29% of net revenue, which led to similar gross profit percentages of 71% at my gym and 73% at Flanagan's. Squat Goals also had lower net income compared to each of the other businesses, but a higher net income percentage compared to Hoppy's Gym. And this is where I really saw the benefit of keeping the operating expenses low. From a liquidity perspective, while my liquidity is not as good as Flanagan's Gym because they have no liabilities, my current assets compared to current liabilities are 15 to 1. So a decently high level of liquidity to meet my maturing obligations. Though also solvent, Squawkles' debt to assets ratio is the highest of the group. This is largely because I leveraged debt to finance the purchase of new equipment. And to satisfy all of my debts, I would need to liquidate 44% of my business. Overall, my gym was profitable, though generated profits slower than I would have liked. We did have an early setback where I lost about a third of my members. Really hit my stride around day 37, recovering those members and seeing an increase in net profit of 295% in the last 23 days of business. At day 60, Squawkles' share price was valued at $6.29. I elected to remain a privately held company, but that left approximately 17,500 in capital that was unused. I could have leveraged to assist with purchasing more equipment or hiring employees. And initially limiting staff did allow the gym to remain profitable with fewer members, and it helped keep my operating expenses lower. But increasing staff after membership began to increase would have positively impacted customer satisfaction and overall profitability.